Hello and welcome back to the live stream here at the 2026 Rule Symposium with me, Paul Harris. Adrian Day's just given his keynote presentation, and what a presentation it was. Adrian's kind enough to join us for a few additional comments here. Adrian, welcome to the live stream.
Thank you for asking me, Paul. And it's very striking how many Brits are here.
Is it the World Cup fever?
I don't know.
Well, we've got a lot to get into because you typically with your presentations you come in with very strong with a lot of data points, a lot of analysis, some very good food for thought there. Many things that I could pick up on, but I want to start here. You said the valuation of the gold stocks it's in its lowest quartile for the last 70 years according to the analysis you've just done. What is the implication of that?
The implication is that if you're a value investor or a long-term value investor, these things they just absolutely should be bought. And a lot of people look at price. I mentioned that. Obviously, we've had this big drop down, in the last few months. But I mean, if you look at, I'll just say Franco. If you look at Franco at $100 2 years ago, you might think that at $200 is expensive. Or Agnico 5 years ago at $35 and now at $160. But, that's price, and you've got to look at valuation. And the reason, you didn't ask me for reason, you said the implication, but I'll answer a different question if I may. The reason for that, of course, is that even as the price of gold moved up so dramatically over three years, the costs did not move up anywhere near as much. And so you had margins expanding dramatically, and with the margins, of course, you had cash flow expanding and free cash flow expanding. And so even though the price of gold, let's say in the last 18 months doubled, the margins and the free cash flow much more than doubled. And so the valuations remain cheap.
Now, the calling valuations cheap, that supposes that at some point in the future they'll be higher. And so, playing devil's advocate, is there a scenario where valuations don't go higher? Perhaps there's a systemic reset?
I think the biggest risk on a fundamental longer-term basis will be the gold price. I cannot see a reason why the gold price would move up and the gold stocks would not adjust to their longer-term valuation metrics. Obviously, we have to look at costs. Costs are important. And you often have a scenario, we saw it in 2007 and 8. You often have a scenario where the gold price moves up, but the costs move up even more dramatically. And so the margins don't expand, the cash flows don't expand. And we saw a period of actually 4 years back in the bull market from 2000 to 2011. We saw a period of 4 years when the gold price was moving up and doubled, but the stocks didn't move at all because the costs were going up. Remember, in 2011, the oil price was $144 an ounce. That's its actual price. That's not, so adjust that for inflation, and costs back then were dramatically higher than they are right now. Think of the Australian dollar and the Canadian dollar. And those are good proxies for mining company costs, right? If you're a US company with a mine operation in Australia, the valuation, the exchange rate of the Australian dollar is a critical component of what your local costs are. Well, think back to 2011 when the Australian dollar and the Canadian dollar were both trading at premiums to the US. They're now trading at 25 and 30% discounts to the US dollar. So the costs today are remarkably low. This is really a sort of, all of the stars have aligned, and that will not continue. I just said how bullish I was on copper and oil. So, I'm expecting the cost to go up. The question is whether they go up dramatically more than the gold price.
Thank you. You talked about the incredible setup for a strong rally at some point. You mentioned stocks are down 40% from their peak valuations, extremely weak sentiment, etc., etc. Given the strong setup, why isn't it happening, or what will it take for it to happen?
Two sides of the same coin, really. I think the main reason that the stocks have remained so undervalued for so long is that up until very, very recently, the S&P has continued to move up. If you're not a specialist in this sector, but you're a dentist in Oklahoma City or whatever, and every month, once a month, you look at your statement and your 401k is continuing to go up, and your 401k is going up because you're invested in an S&P index fund, you don't have the incentive to look anywhere else. When we know what's happening underneath the hood, if you like, we know what's happening to the internal dynamics of a market, the terrible bad breadth, where 5 companies represent 40% of the index, and they represent about 60% of the growth in the appreciation in the S&P. But if you're the guy looking at your statement once a month, you're not looking at all of that. You're simply saying my statement's up. But when you have 1, 2, 3 months in a row where the S&P goes down, then I think people are going to start calling their advisors saying, hey, should I be invested somewhere else?
To what extent are we sort of talking about, let's say, the hopium aspect of the tech stocks? To what extent are we in similar ground as we were at the turn of the millennium with the dot-com stocks that became the dot-com bubble? The non-cash flowing, non-profit
generating. In my mind, there is absolutely no question about it. And the problem is when you're living in a bubble, prices are determined by buyers and sellers, right? So there's obviously some people that think the prices are worth paying. And there's always stories and arguments and a narrative and so on. And the more dynamic, the people that appear on CNBC telling their stories are much more attractive than a mining CEO talking about what he's digging out of the ground. But there's no doubt in my mind that we're in a bubble. And I just pointed out in the video, when you look at a bubble, Alan Greenspan famously said, you never know a bubble till it's over. I don't agree with that. But you never know when it's going to burst. I would say that's absolutely true, because these things can go on much longer than you think they can. But you look at the sort of exponential moves that we've had in these markets of companies, and the critical thing, these are companies with no revenues by and large, certainly no revenues from the AI data centers, which is making a move. Same as the dot-com bubble, most of the companies were not didn't have any revenues. And you look back to these bubbles throughout history, look back to the late 1980s with the Japanese stock market bubble. You got that exponential move up, and as soon as it burst, within less than a year, you were right back to where you were before the bubble started. Same with the dot-com bubble, and I think the same is going to be true here. The big question is you don't know when it's going to burst. But to me, you don't have to be a hero. You don't have to go short. You don't have to, just don't buy them. Because and again, I gave that slide in there about NVIDIA, because to me, that is just, I always look at relative valuations. Relative. What is this worth compared with other things? Really, would you buy all the gold stocks in the world, all of the German market, all of the British market, or would you buy NVIDIA? The question answers itself, I think.
Okay. One of the other key points I think you made during your presentation is the fact that we've been through, or we're still in a very long period of extreme underinvestment in copper across the commodities space. Is there a light switch moment where that investment starts coming back and it starts being replaced? Rick Rule has spoken about a similar thing in the oil and gas space,
right?
Chronic underinvestment.
Yeah, Rick has talked about this a while, and he's explained it very well. As he likes to say, the solution to high prices is high prices, the solution to low prices is low prices. And if you think of the commodity cycle as an investment cycle, not as an economic cycle, these things make sense. People often say to me, well, the economy's so strong, why are the stocks so weak? Or vice versa at other times, well, the economy's so weak, how come the metals are so strong? It's an investment cycle. So when you get to 2011-12 with really high prices, companies, all the resource companies can raise money, right? They can all raise as much money as they want. They start doing expansions. They start bringing on new projects, right? They start taking over other companies. They start exploring. But all of those things that they're doing take 5, 7, 10 years before we see the production. So even though we have this gross overinvestment in 2011, 12, 13, we didn't see the fruits of that in terms of production until 17, 18, 19. And then at that point, you know, the prices have been low for so long, but the prices have come down and the prices are low. But just as we're about to see this new influx of production, everybody's giving up and companies can't raise any money and, you know, and so on. But when they put their projects on hold, that doesn't affect the current production. It affects production 5 years out. And so that's why you have these long swings in the commodity cycle. And again, it's an investment cycle. What will change that, I think, is when we have consistently higher prices for a period of time, and we're beginning to see that. We're seeing stepped up investment in the gold and silver space. We're seeing stepped up investment in the copper space, but we won't see increased production for another 10 years. So from an investment point of view today, it's not really relevant, but we are seeing that increased investment.
So is part of your thesis then, you know, better days are to come, so position, sit tight, be patient, and wait for it to benefit you?
Well, your words, but I'll agree with them.
Okay, excellent. Well, we are out of time, so
Okay.
Adrian, thank you very much for joining me for some additional comment today.
Thank you very much, Paul. Thank you.
We have a lot more to come from the 2026 Rule Symposium live stream, so sit tight.